Hello everyone and welcome to today's session where we would be discussing AS2. Now this must be a standard which is slightly familiar to you, the standard on inventory, because this is something that you might have even touched upon, though at a very preliminary level at your CA foundation. Cost or NRV, whichever is lower, is what you take as inventory, and also a lot of your costing, if you have done, is based on measuring the cost of the inventory. So over here, what exactly is inventory? Now as per AS2, inventory is something that you hold for the purpose of sale in the ordinary course of business or for the purpose of consumption in the ordinary course of business. Like if I am buying a car, that car is usually PP because I am holding it for use. However, if I am Toyota and if I am holding the car for the purpose of sale in the ordinary course of my business, then the car is inventory for me. I am holding it for the purpose of sale in the ordinary course of business. However, that is not it. I might be holding, let us say, materials like tires, steel, plates, etc. All of these are raw materials that I am going to consume to make that car, and these are also treated as inventory. So when I look at inventory, there are 6 broad headings covered under inventory. Items which are held for the purpose of sale, like finished goods for a manufacturer or a stock in trade, let us say for a trader, this is definitely inventory. Apart from that, raw materials which are used for the purpose of making the inventory, like a tire for a car or work in progress as on the balance sheet, an unfinished car, are also taken as inventory if I am Toyota. Now there are 2 items like loose tools like screwdrivers or consumables, stores and spares like nuts, bolts, etc. These don't have a parent standard, and hence AS2 also covers them, loose tools, consumables, etc. So even loose tools, stores and spares are covered under this standard. So what is not covered under AS2? Work in progress for construction contracts. Why? Because there's a separate AS7 for that. Work in progress for service providers. Now inventory AS2 covers physical inventory. If I'm a service provider like a coaching institute and half of my batch is complete, that is work in progress. However, that is work in progress for a service provider will not be covered under AS2. Third is if I am a financial institution like a Kotak Mahindra Bank and I am holding shares on my own account as inventory, I'm in the business of buying and selling shares, in which case I'm a stockbroker, that share or debenture investment will go under AS13. So these 3 are very clear. However, the 4th one is a little tricky. If you are a producer of, let us say, forest produce or agricultural produce or livestock, for example, you are a farmer, in which case your inventory will not be covered under this standard. In fact, it will be recorded as per a separate guidance at net realizable value. But mind you, this is only applicable to a person directly engaged primarily in agriculture, like for example a farmer, a producer. If let us say you are a trader, that is, you were to buy this crops and sell it to someone like a wholesaler, retailer, then AS2 will very well be applicable. This exception of applying NRV is only and only applicable to producers of agricultural produce and not traders, wholesaler, etc. Okay, so this is something that you need to remember. Now, inventory recognition under AS2 is having 3 main parts. First is how do you measure the cost of the inventory. Second, how do you treat the cost flow like COGS, etc. And third, how do you value the remaining closing stock. So there are 3 things. First is measurement of cost. The cost measurement is by and large similar to what you study for AS10 or AS26 if you have done that earlier. So when you look at AS2, inventory can be recorded at cost initially, but how do you measure the cost? Well, if I have purchased the inventory like I'm a trader, then the purchase price minus trade discount, if any. Cash discount, remember, will go to the P&L. Cash discount linked to early payment, whereas trade discount is every other discount. You should deduct trade discount while determining the purchase price. Next, what if there are taxes, indirect taxes? If they are non-creditable, non-refundable, then they will be added to the cost. However, if they are refundable or creditable, then they will be taken directly to the profit and loss account. In the sense that they will not be added to the cost, they will be taken as a GST. For example, GST receivable is not an expense if I can claim credit on that. However, if credit cannot be claimed, it is a part of my cost. Then there is directly attributable expenses. These are expenses which are incurred to get the inventory in the location and condition as desired by the management. So if I am importing inventory, then the freight, loading, unloading charges, all of that is directly attributed to get the inventory in the location and condition as desired, and hence they will be a part of the cost. Next, when you go to inventory which is manufactured, so this is slightly more important, I would say, as compared to purchase inventory. Here, instead of purchase price, you will have raw materials, in this case raw materials consumed plus direct labor plus direct expenses plus overheads. Now overheads are like, you have a factory, you need to pay power cost. the more you use the factory, the more power, less you use the factory, less power. So that is a variable production overhead or a fixed production overhead, like a factory rent. Factory rent for the entire factory is not paid on a per unit basis. However, that is directly attributable to making the inventory. And hence I will use something called as absorption costing that you will study in costing, where you will try to find the cost per unit. So you will say if the factory rent is 10 lakh and I'm making on an average 1 lakh units, that means on a per unit basis, on an average I'm paying 10 rupees. This is your overheads, absorption as you call it. So this is taking on a per unit basis. You will do it when you do costing. Variable overheads plus the fixed production overheads. Remember, overheads will be of three types. There is production overheads like factory rent, administrative overheads like head office rent or accountant salary, selling and distribution overheads like for example salesman's commission, etc., of which in inventory you will say only the production overheads, where the fixed or variable will be taken. Administrative, selling and distribution, or even general overheads are not directly attributable to making the inventory item, and hence it should be taken to the profit and loss account. So over here, any other directly attributable expenses, will be taken directly to the cost of the inventory if they are directly attributable. But if it is selling, distribution, administration, they will be taken to the P&L. Directly attributable expenses over here, like for purchase inventory, will be added, and non-refundable, non-creditable taxes, if any, will also be added. Lastly, if this asset that you are manufacturing is a qualifying asset, that is as per AS 616, it is taking a substantial bit of time to be ready for its intended use, then the borrowing cost attributable to that during the period of construction can also be capitalized if it is a qualifying asset as per AS 16 principles. Okay, so this is regarding cost. Now there are a few special features that you need to remember. First, when you calculate the cost, there are three specific items which will not be a part of cost. First, administrative, selling and distribution, and general overheads, where the fixed or variable will not be a part of cost. Second, storage cost. Now usually storage cost does not really result in a change in the condition of inventory as you desire. So if the storage cost, like you just buy the inventory, store it, and once the customer likes it, they take it away. So there's no desired change. Storage cost should not be capitalized. However, if the storage cost is something which results in a desired change in the condition of the inventory, like for example, you buy grapes, you dry it off, and it becomes that dry fruit of kishmish or something that you call it. The drying process is something which is necessary. The storage is necessary, can be capitalized. Or wine, you store it for the purpose of fermentation, so that the wine ages, and it is something that you want to sell, an aged wine, in which case the storage cost can be capitalized. Otherwise, storage cost will go to the P&L. And the third and the last thing, for which you need some specific guidance as well, is normal and abnormal loss. Now, normal loss is something which is normally expected, and as per generally accepted cost accounting principles, normal loss will be a part of cost, whereas abnormal loss is something which you did not normally expect, and hence abnormal loss will be taken to the P&L. This is as per generally accepted cost accounting practices. So three things that will not be a part of the cost will be: first, selling, distribution, administrative and general overheads; second, storage costs unless the storage is necessary to bring about the desired change; and third is your abnormal losses. Normal loss can be a part of cost, abnormal loss will be taken to the P&L. Now, how do you determine the normal and abnormal loss? So, over here, for example, let us say I were to buy 100 liters of water at the rate of rupees 10 per liter, in which case my total cost comes to 10,000. Now, if someone asks me to calculate the cost per liter, I'll say 10,000 divided by 1,000 liters, that is equal to 10 per unit. However, in this particular case, it is very much possible that, let us say, you expected a normal loss of 5%. That is, when I purchase 1000 liters, I expect that I will receive only 950 liters, and hence there's a 5% or a 5% that is 50 liters of normal loss, in which case my cost per unit will be 10,000 divided by 950, which will come to what? 10,000 divided by 950 comes to around 10.53. This is my cost per unit. Now, when I look at the cost per unit, 10 rupees I am paying to the supplier, but 0.53 is the addition implicitly for my normal loss. Like 50 liters are lost. 50 liters into, for example, 10 rupees per liter, that is 500 divided by 950 liters that are remaining, that is 0.52 rupees is the addition to my cost due to the normal loss that I normally expect. However, it is very much possible that actually you normally expected that you will receive 950 liters, you actually received only 920 liters. That is, there was 80 liters of total loss, out of which 50 is normal. That means the remaining 30 is abnormal. What do you do with the abnormal loss? So it will go to the P&L account. So if I want to calculate abnormal loss will be 30 liters into 10.53 per liter, so that is around 315 point something. 9 will be taken to the profit and loss account as abnormal loss. Now that means for calculating abnormal loss, you will find the abnormal loss in units, that is maybe 30 liters, into the cost per unit, that is equal to the total cost divided by normal units. Okay, but another situation is, instead of receiving 950 liters, you might also rarely receive 980 liters, in which case there is an abnormal gain. So when I look at abnormal gain, there is a 30 rupees abnormal gain. Okay, so what do I do? Do I take this gain to the P&L? Standard says no, because prudence and conservatism says that when there is a loss, you can recognize the loss in the P&L as soon as you expect it. But a gain you can recognize only when you actually earn it. So here what can happen is, if I have merely purchased the 1000 liters, paid 10,000 rupees, and if I am saying that the cost per unit is, for example, 10.53 into, if I do 980, 10.53 into 980 will actually land up to around 1031. So there will be a 31 or 10,319. There will be a 315 or something gain. Now this is something which we will say is a little wrong, because you have merely purchased water. Merely purchasing water does not give you a gain, and hence the standard says in case of abnormal gain, you will take the total cost divided by the normal or actual, whichever is higher. So over here I will say 10,000 divided by 980. Now this may be a little confusing for a student. When do I take normal, when do I take actual? Just remember a general rule: while calculating the cost per unit, you will take the normal units or the actual units, whichever is higher. If there is an abnormal loss, then you will get 920 instead of 950, so you will take normal units, that is 950, and thereby abnormal loss will go to the P&L. But if there is an abnormal gain, that is 950 or 980, then you will take 980. Cost per unit will be adjusted to 10.2. There will be no gain recorded today. However, in the next year when the water is actually sold, the cost per unit is only 10.2 instead of 10.53, and if the selling price is 11, the gain would relatively be higher. So the general rule that you will remember is, normal loss should be a part of cost, whereas abnormal loss should go to the P&L. Here, how will normal loss be a part of cost? Usually total cost divided by normal units. However, if there is abnormal loss, then still your cost per unit is total cost divided by normal units, that is 10.53, and the abnormal loss of 30 into 10.53 will be taken to the P&L. But if there is an abnormal gain cannot go to the P&L, and hence you will revise the cost per unit taking 10,000 divided by 980, that is actual, and hence 10.2 will be the cost per unit. Long story short, you will take total cost divided by normal or actual, whichever is higher, for the purpose of cost per unit calculation. Okay, so that is note 2. Next, when you go to note 3 is an important note, I would say, and if you understand note 2 properly, then note 3 is a little more manageable. This one, fixed overheads absorption. When you will study costing, you will see that fixed overheads are absorbed based on different bases, maybe based on units, hours, labor, whatever. Generally for accounting we will use units. So if I have a factory rent worth 1 lakh and that is used for manufacturing, let's say close to 10,000 units, because my factory has a normal capacity of 10,000 units, in which case I will say 10 rupees per unit is my absorption rate. Actually factory rent is a fixed cost. I don't pay it on a per unit basis. However, I want to find the cost on a per unit basis, so I convert the fixed cost into per unit by dividing usually by the normal units. Now the problem over here is, it is possible that your normal may not necessarily equal to actual, which means in the first case it is possible that your actual units are, let us say, 8,000. Now you normally expected that 10,000 will be made, but let us say for some abnormal event only 8,000 are made, or your actual in the second case can possibly be 12,500. You normally expected 10,000 to be made, but by the way, because of some bumper event, 12,500 could be made. Now I want to find the cost per unit. How will I do that? Well, I will still apply the normal and abnormal loss principles. I will say if there is an abnormal loss, it should still go to the P&L. If there is an abnormal gain, it should not go to the P&L currently. It will be adjusted against the cost. So what will I do? I will take absorption rate as 1 lakh divided by, in this case, normal or actual, whichever is higher, still that is 8 or 10, whichever is higher, that is 10, and hence this will be 10 per unit. Whereas when there is an abnormal gain, I will take 1 lakh divided by normal or actual, whichever is higher, so this is 10 or 12.5, whichever is higher. So over here your absorption rate gets revised to 8, whereas over here your absorption rate continues to remain 10. So what will happen over here is, during the year you have paid 1 lakh of rent, this will go to the P&L. Now if I do stock taking and assuming all stock is unsold, I'll have 8,000 units into still 10, and hence my closing stock will be 80,000. So 20,000 over here will be my abnormal loss, will go to the P&L account. But on the other hand, over here I have a 1 lakh rupees cost still. Now if I do stock taking and if everything is unsold, 12,500 into, I will multiply 8, and hence it will be 1 lakh rupees. There's no profit, there's no loss, but I can't recognize a gain on merely producing units, and hence when I look at absorption rate, usually it is fixed overheads divided by normal output, but in sums where normal is not equal to actual, you remember the rule that if actual is lesser, it is like an abnormal loss, you could produce less, but if normal is greater, let's say an abnormal gain, you will take fixed overheads based on normal output, because normal or actual, whichever is higher, and second case you will take based on actual output. So basically, in short, take normal or actual, whichever is higher. It's a little confusing, a little something that you will need to practice. We'll do sums on this. Okay, next you have joint products and byproducts. Now on this, in your May 24 exams, there was a very good question, I think question 1B or something, that we will also solve, that was there largely on joint products and byproducts. You will do a separate chapter in costing as well. What does joint product or byproduct mean? Well, let us say I was to purchase a crude oil and do some processing on that, whereby there are 3 products that come out. There is petrol, there is diesel, and there is a chemical one. Now I am in the business of selling petrol and diesel. Chemical one, by the way, comes out. So I'm not really serious of selling chemical one, but the nature of process is such that byproduct, that is chemical one, comes out. Byproduct is a product that comes out by the way. You never intended to make it, but by the way, the nature of process is such that it comes out. Like when you make butter, buttermilk comes out, that is a byproduct. Byproduct is something where the management is not serious about selling it, management does not keep any detailed inventory or records for that, and hence byproducts as per AS2 are to be measured at NRV, and they will be reduced from the net joint cost. So you will calculate the total joint cost, but that joint cost is for petrol, diesel as well as chemical one. I will measure chemical one at NRV and find the net joint cost, that is the total joint cost minus the NRV of the byproduct, that will give me the net joint cost, and that net joint cost will be split between the main products, that is petrol and diesel, in the ratio of their sales value at split of one, not in the ratio of their quantity, not in the ratio of the sales price per unit, but in the ratio of their sales value, that is quantity produced into the sales price per unit in the ratio of the sales value at the split of point. So over here the net joint cost attributable to the main products, that is total joint cost minus NRV of byproduct, should be allocated to the main products, that is petrol and diesel, in the ratio of their sales value at the split of point, that is quantity produced into the selling price. That will give you the allocation. Okay, so this we'll do a sum on this, I think question 20 or so in our material, which will give you a much more detailed understanding for joint product byproduct, and there are multiple sums for fixed production overheads as well. Right now we are just very clear on the concepts. Next you have cost flow assumptions. Now what do you mean by cost flow? This is the second part of your standard. Cost flow assumptions is just a sophisticated name for figuring out how is the cost flowing. Now usually for fixed assets, if I were to sell a particular fixed asset, I'll have to find out the WDV of that specific fixed asset to find a gain or loss on sale. But for inventory that can become very tedious. So if I'm a dealer in, let us say, tires, or let us say some vegetables, to keep it simply, if you see, when you go to buy vegetables, people select vegetables. So my vegetables that are sold, I don't know which of them are sold, out of which unit. So do I sit and have to find specifically? The standard says no. It says if your inventory units are interchangeable. So if there's a pile of tomatoes, you pick up any tomato that you want. These tomato units are interchangeable. So over here, if my inventory units are interchangeable, I can use methods like FIFO, first in first out, or weighted average, that is the opening stock in rupees plus purchase in rupees divided by opening stock in units plus purchasing is in units. So that will give you the weighted average cost per unit. So that will give you the weighted average cost per unit, weighted average, and you can use that, or you can use FIFO. FIFO means inventory that is purchased first is going to be sold first, which means whatever is there in your closing stock must be made up of your latest inventory. Okay. Remember, LIFO is not permitted, simple average method is not permitted. Now these are general methods that almost all entities use. However, in certain cases inventory units are not interchangeable. Like for example, you are selling paintings. Now there may be 3 paintings, they are not interchangeable. In which case I'll have to use specific identification method. I'll have to specifically identify which painting is sold and find the cost of goods sold based on that exact same painting. So over here, if inventory is not interchangeable, you will take specific identification methods usually used for paintings, precious items, artifacts, etc. But in general, inventory is interchangeable, in which case you can use FIFO or you can use weighted average. However, in 2 specific cases, the standard gives you exceptions, which is optional, not mandatory. Like if I'm a manufacturer with a long production history, then I can take the standard cost for valuing my inventory, provided my total actual cost approximates my total standard cost. We'll do a sum on this as well, standard cost. Used for manufacturers in case the standard cost approximates the actual cost. And second, for retailers, departmental stores who are selling multiple products, it might be very difficult for them to find the FIFO weighted average for each category of products separately, and hence the standard allows you to recognize something called as a retail sales price method, where you take the MRP sales price minus the gross margin. So if you go to a retailer, they will know the MRP of these items very easily. They will know the margin, like electronics I earn 5%, in apparel I earn 30%, in cosmetics I earn 50%. So I'll take the MRP of these items, sales value, minus the gross margin. That should loosely give me the cost. Remember, it is not mandatory to use this method. You can always use FIFO or weighted average. Like in today's environment, there's barcoding, so you can easily find out even for a departmental store. However, if you don't have that, it will be very tedious, and hence the standard allows you to take the sales value, total sales value of the unsold items minus the gross margin, and that will give you the cost. Again, we'll do a sum on this. So retail sales price method used for retailers, selling price minus gross margin should give you the cost. And the last part for the standard would be, how do you value the inventory at each balance sheet date? If it is finished goods or work in progress, then the inventory will be measured at the lower of cost or net realizable value, whichever is lower. Remember, inventory is not depreciated, which means whatever is the initial cost that you recorded earlier would continue. There will be no depreciation because you're not using the inventory. However, it is possible that if the inventory does not get sold or the market changes, the value of the inventory might fall. And hence we said that if we are not depreciating the inventory, we should be alert that the inventory should at least be capable of giving me what is recorded as cost. So if the cost of the inventory is 100, but the NRV, net realizable value, is only 80, that means as a 20 rupees write-off, a loss which will be taken to the profit and loss account. Now, how do you calculate the NRV? NRV is the estimated selling price of this inventory minus the estimated selling expenses. Like if I'm selling car, 100 rupees I get on the sale of the car, but I don't sell the car directly, I sell it through the dealer, and hence I have to pay a commission. So if I sell the car at 100, I'll have to pay 10% commission, and hence in hand I will get only 90 rupees. NRV is net realizable value. So that is estimated selling price minus estimated selling expenses which are yet to be incurred. However, this is for finished goods. For WIP, it is possible that you have an unfinished car. Now, unfinished car has no market. There's no NRV. However, if I finish the car and if I sell it, I will get 100 rupees for a finished car, for which again I'll have to spend 10 rupees. So is my NRV for a WIP also 90? Answer is no. Why? Because I'll have to incur another expenses to complete. So I will say my inventory is currently unfinished. It is costing me 60 rupees. I can sell it. In an unfinished condition, I'll get nothing. However, if I incur another 40 rupees, let us say, then the inventory will be finished and I can sell it. Achha, at what value can I sell it, sir? 100. But to get 100, I will have to incur 40. And hence 100 minus estimated completion cost minus estimated selling expenses. 100 minus 40 minus 10, that will come to 50. Compare 50 with the cost of the WIP and select whichever is lower. So over here, valuation of the inventory will be work in progress or finished goods or stock in trade. This is cost or net realizable value, whichever is lower. Cost or NRV, whichever is lower. That will give you, let us say, the value of your finished goods or WIP inventory. Now, the important part over here is the raw materials inventory. Now, raw materials inventory, someone will say, will still be measured at cost or NRV, whichever is lower. AS2 says no. Why? Because finished goods and maybe WIP once I complete is held for the purpose of sale. Raw materials is not held for the purpose of sale. So I might buy tires at 100 rupees, then the price becomes 90. How does it matter? I don't want to sell the tires. I'm going to consume the tires, not sell it, and hence ideally my raw materials should be valued at cost only. I should not even compare it with NRV. I should value it at cost only. Perfect. So raw material stock should ideally be valued at cost only in general, provided these raw materials are going to be used in a profitable finished good. So over here, when I look at raw materials, if the cost of the finished goods is less than the NRV of the finished goods, that is the profitable finished goods, then the raw material stock will be measured at cost only. Why? Well, because if the finished good is profitable, then the raw material that I have is in all likelihood going to be used to make that finished good. However, if the finished good is loss making, that is cost of the finished good is greater than the NRV of the finished good, is by and large a loss making finished good, then like in your language you call it like a red flag. It is like a red flag in the sense that it is, we say that we are going to always consume the raw material. Well, you are going to consume it by and large if the finished good in which you are going to make it is profitable. But what if the finished good in which this inventory is going to be used is loss making, in which case it is likely that you might not use this to make that finished good, in which case you might have to sell it. And hence in those cases where there's a loss making finished good, and most of the sums that have come in your exam, you have a loss making finished goods, when you have to measure raw material inventory, you measure that at raw material stock at the lower of cost और रिप्लेसमेंट कॉस्ट. अब ये दूसरा प्रॉब्लम है, रिप्लेसमेंट कॉस्ट क्या होता है? Ideally should take the NRV. Yes, NRV is based on the estimated selling price. Now, if you are a dealer in cars, you know the price at which you sell the cars. However, you have never sold tires, and hence you don't know the estimated selling price of the tires, but you have purchased the tires. So you know the price at which you can purchase the tires, and that is called as the replacement cost. So we take that as a proxy for the NRV. NRV is based on the net selling price, estimated selling price, I know the price at which I sell my finished goods, but I don't know the price at which I sell my raw materials because I usually don't sell my raw materials. However, I purchase my raw materials, so the price at which I will purchase the raw materials on 31st March must be the price at which I can even sell them if I need to on 31st March. So that is why we use the word replacement cost. But remember, for raw material stock, you will always have to first find the finished goods, see the cost of the finished goods, compare it with the NRV of the finished goods. If the finished goods are profitable, then raw material stock will be at cost only. But if the finished goods are loss making, then it will be at the lower of cost or replacement cost, whichever is lower for raw materials, for which you will have to write a note in the exams. So over here we have some explanation on what is the NRV, estimated selling price minus selling expenses minus cost to complete, and what is the replacement cost. A couple of other things that you should also know is inventory valuation. Remember, happens on a category, individual category basis. Like you have A and B. A has a cost of 100 and NRV, for example, of 80, whereas B has a cost of 100, NRV of 120. Now you will not make the mistake of taking the total cost and comparing with the total NRV. This is wrong. You will do the AS2 valuation on a group, not on a group basis, on a category wise basis. So this is 100 or 80, whichever is lower, so 80, 100 and 120, whichever is lower, so this is 100, and hence your AS2 based inventory will be valued at 180. Similarly, it is possible that you can measure the inventory at the lower of cost. This is 100, or NRV, which is, let us say, 80. So your carrying value, that is the amount at which inventory appears in the balance sheet, is 80, and hence you can recognize a write-off in the P&L to the tune of 20 rupees. But let us say this inventory remains unsold. In the next year, this inventory now carries a value of 95. So can I remeasure the inventory? Yes. Remember, it is to be recorded at cost or NRV, which is lower. Cost is still 100. Sir, it is 80 in my books. It is carrying value is 80. Cost is the amount that you have paid. It is still 100. So 100 or 95, whichever is lower, this will be measured, let us say, at 95, and hence there will be a reversal of 15. There is no reason why you can't reverse. But yes, you can't go beyond 100. So when I do 100 or 105, whichever is lower, in this case it will be 100, and hence you can reverse 20. You can't go all the way up to 105. Maximum you can go up to 100. That is, you can't go above cost. So that is what is there regarding AS2 for the purpose of your inventory. Now you will go to the sums for the same. So we'll go to these questions. Now there is question number 1, which is, I would say, an important question. There is a similar question, I think question 8 as well. So let us review this. It's quite an interesting one. Joy Limited purchased 20,000 kilograms of raw material at 20 per kilogram during the year 2021. They have furnished you with the following information for the year ended 31st March 2021. So they have purchased 20,000 kgs of raw materials. We have all of this: finished goods, raw materials, direct labor, fixed overheads. The important thing over here is the plant has a capacity to manufacture. We have been given that the plant has a capacity to manufacture 30,000 units of finished products per annum. However, the actual production of finished products during the year was only 20,400. So finished goods actually is 20,400, whereas your capacity is 30,000. So your fixed overhead absorption might be affected. Due to a fall in the market demand, the price of the finished goods in which the raw material has been utilized is expected to be sold at 40. So this is your NRV, let us say, for the finished good. And the replacement cost of the raw material was 19 per kilogram. You are required to ascertain the value of closing inventory as on 31st March 21 as per AS2. Now if I go to see, if I want to find the raw materials consumed, my opening stock of raw materials was 2,200 plus the raw material purchase was 20,000 kgs and the closing stock of raw material was 1,800. So if I do this working, I will possibly get around 20,200 kgs of raw material, or 20,400, what is it? 20,400 kgs of raw materials consumed. Okay, so if I want to find the cost per unit for the closing inventory, I'll have to find the cost of the finished goods. I can do that on a per unit basis, or I can even do that on a total basis. Like for example, I will say a raw materials consumed plus direct labor plus, let us say, fixed overheads. So over here I can do this on a per unit basis, or I can even do this on a total basis. Remember, you are manufacturing 20,400 units for which you have consumed 20,400 units of material. Now if you look at your raw material stock, this is 44,000 divided by 2,200, that is 20 per kg. In a similar way, 20,000 kilograms at the rate of 20 per kg. So the rate is around 20 per kg. Now if I go to see, my raw materials consumed in total will be 20,400 into 20. Per unit this is 20, so this is 2,400 into 20 comes to around 4,08,000. Apart from that, labor. Now assuming otherwise, labor will be variable, and hence if I go to see, there will be 3,06,000. I will say 3,06,000 is my variable labor cost. 3,06,000 divided by 20,400 is the units which are produced during the year for which labor must have been spent. So this is 15. So this is divided by 20,400 units, and now comes the problem. When I look at fixed overheads, my fixed overheads are 3 lakhs, but the problem is 3 lakhs will be divided for the absorption rate by the normal units or actual units, whichever is higher. So this is 30,000. Remember, for variable or for labor, you don't do that. That is incurred only for the actual units. However, fixed overheads are actually period cost, and hence to find the cost per unit, you divide it by, let us say, 30,000 or 20,400, whichever is higher, and hence that is equal to 30,000. So this is 10. And hence if I were to take 20,400 into 10, that comes to 2,04,000. Now that is the overheads absorbed. Now one can always say, what about the remaining 96,000? That must be unabsorbed, like abnormal loss would be taken to the P&L. So if I total up, this will come to, I think, 45, and this will be 408 plus 306 plus 204 comes to 9,18,000. Now just to reconcile, 9,18,000 divided by 20,400 should exactly tie up with 45. So this is your total cost. Now this is the cost for your finished goods. Now I even need to do the working for raw material. So if I look at the finished goods, my cost is 45. My NRV of the finished goods is 40, and hence as per AS2, my finished goods will be measured at the lower of the two, which is 40, into the number of units. If I go to see at the end, the number of units over here are, I think, 2,400, and hence 40 into 2,400, if I am not wrong, this will come to a closing stock value of 96,000. Raw materials are measured at cost of 20. Even the units purchased during the year or in the earlier years are at 20 rupees. If I look at the replacement cost, this is 19, but should I look at the replacement cost? Yes. Why? Because the cost of the finished goods is greater than the NRV of the finished goods, and hence this is a loss making finished good for which this raw material is going to be used, and as a result over here I'll compare the cost or replacement cost, whichever is lower, comes to 19 into, I think, 1800 units. So this is 19 into 1800 units. This is 34,200 of your total value, and that is about it. So if I total this up, I think this is 1,30,200 will be the closing value of your inventory. It is probably one of the best questions, I would say, definitely for your LDR. You should revise. One of the best questions which can be asked. It has a lot of concepts: fixed overheads absorption, raw material consumption, comparing cost on NRV, comparing cost of replacement cost. So definitely revise this and do this properly. A similar question number 8 is also there. So if you want, you can practice that separately. So this is question number 1. Next you go to, so you can see over here 1,30,200 is your final value. Next you go to question number 2. X company limited purchased goods at a cost of 40 lakhs in October 16. In March 17, 75% of the stocks were sold, which means 25% of the stock remain unsold, that is 10 lakh rupees. The company wants to disclose the closing stock at 10 lakhs, that is at cost. The expected sale value is 11 lakhs and a commission at the rate of 10% on the sale is payable to the agent. Okay, so my NRV will be 11 minus 10%, that is equal to, I think, 9.9. Advise the correct closing stock to be disclosed. So this will be cost, that is 10, or NRV, that is 9.9, whichever is lower, so that is 9.9, and hence 10,000 will be expensed off to the profit and loss account. So that is question number 2. Next you go to question number 3. A similar question has also come in the exam. We will review that later. In the production process, normal waste was 5% of the input. 50,000 metric tons of input were put in the process, which means at 5% your normal output would be 4750. So 250 would be your normal loss, resulting in a wastage of 300 metric ton, which means your abnormal loss would be 50, that is 300 minus 250. The cost per metric ton of input is 1000 and the entire quantity of waste is at stock. Said with reference to AS, how will you account for inventories in this case? So if I want to find the cost per unit, I will say for 5000 metric tons that I have to pay to the supplier, 1000 per metric ton, and hence 50 lakhs is my total cost. However, I will take normal or actual, whichever is higher, and hence that is I will take 4750. So if I were to take 4750, that is normal output. Actual is 4,700. So this is 50 lakhs divided by 4750 will come to around 1052.63. If I want to find the abnormal loss, that is 50 into 1052.63, and that is about it. So abnormal loss, closing stock will be 4,700 into this, abnormal loss will be 50 into this. Okay, next we have question number 4, very basic. You are required to value the inventory per kg of finished goods consisting of material, labor, direct, variable overheads. All of this will be a part. Fixed production overheads based on normal capacity of 2 lakhs is 20 lakhs. That means 20 divided by 2, that is equal to 10 per unit. So that is another fixed production overheads will be a part of your cost, and hence your total cost will be 240, 260 and 270. 270 is per unit into 4000 kgs of finished goods are in closing stock. So 270 into 4000 will be your closing stock value. Okay, so this is question number 4. Next, go into 5. On 31st March, a business finds that the cost of a WIP, partly finished unit, was 530. So this is for WIP, not for finished goods. 530. So this is your cost of my WIP, 530. The unit can be finished in 17-18, that is the next year, by an additional expenditure of 310. I have not incurred the 310 as of now. I will incur it in the future. The finished unit can be sold for 750 subject to a payment of 4% brokerage on the selling price. Okay, so this is 750 minus 4%. The firm seeks your advice relating to the amount at which the unfinished unit should be valued on 31st March 17 for preparation of accounts. Assume that the partly finished unit cannot be used in the semi-finished form and NRV is 0. However, the NRV of the WIP will be 750 for the finished goods minus 4% brokerage. However, I can get 750 minus 4%, 720, but to get that, I'll have to incur 310 of additional processing cost. And hence, if I subtract this is 410, and hence the valuation will be at 410, and the difference of 120 will be taken to the P&L account. So this is 410, the valuation base for WIP. Question number 5. Next is question number 6. A private company manufacturing fancy terry towels. So my output over here is towels. Is valuing its closing inventory of finished goods at realizable value, inclusive of profit and export cash incentives. Now this is wrong. You have to, these towels, they are not agricultural produce or anything to be measured at realizable value. So they have to be measured at the lower of cost or NRV. Now over here it is clearly given that your realizable value is inclusive of profit. So for example, if your cost is 100, realizable value will be 100 plus 20, that is 120. Now that is not going to work. And export cash incentives. Maybe you are planning to export the towels and hence the government is going to give you 10 rupees of incentive. So maybe you have shown it at 130, that is 100 of cost plus 20 of profit plus 10 of export cash incentives, and you have shown this as NRV of 130, which is wrong. Firm contracts have been received and goods packed for export, but ownership of these goods have not been transferred. Remember, merely because I have a firm order, that does not mean that I can recognize the income, because for all you know, the towels are still under my risk. There may be a fire, flood or an earthquake and I might suffer a loss. So till the time I actually make the sale, I cannot recognize the profit. You are required to advise the company in respect of the valuation of inventory. Will they have to be shown at the cost or NRV, whichever is lower. In this case, clearly the cost will be lower because the NRV includes profit as well as cash incentives. Export cash incentives will be recognized when the export actually happens, whereas your profit will be recognized when the sale actually happens. Nothing to be recorded currently. So this is question number 6. Next we have question number 7. Now this is maybe a slightly easier version of question number 1, but nevertheless we can mark this as important for practice. A has engaged in manufacturing of chemical Y which has raw material X. The company provides you with the following information for the year ended 31st March 17. So you have raw material X, cost price, unloading charges, freight inward, and then replacement cost. So if I want to take the total cost, this will be probably 440. This is for each unit of the material consumed, compared with the replacement cost. Remember, you will compare it only if your finished good is loss making, that is cost of the finished good is greater than the NRV of the finished good. Now for chemical Y, the materials consumed is 440, this makes sense. Direct labor and variable overheads. Total fixed overheads for the year was 4 lakhs based on normal capacity of 20,000, and hence maybe 4 lakhs divided by 20,000 comes to 20 per unit. So this will also be a part of my overall cost. And hence I will take 440 plus 120 plus 80 plus 20 comes to 660. My total cost of the finished goods is going to be 660. Closing balance of raw material was 1000 units and chemical Y was 2400 units. You are required to calculate the total value of closing stock of raw material as well as chemical according to AS2 when the NRV is 800. So cost of 600 or NRV of 800, whichever is lower, and hence this is 660, and hence your closing stock of your finished goods and raw materials. For finished goods, it will be 2400 into 660, and for raw materials, well, it will be 440. Sir, cost, should I compare the replacement cost? No. Into 1000. Why? Because the finished goods are selling at an NRV which is higher than the cost. It's a profitable finished goods. So in the first case, this will be what? 2400 into 660 comes to 15,84,000 and 440 into 1000 comes to 4.4 lakhs. Now in the second case, NRV is 600. Now if the NRV is 600, your finished good is loss making. So this is 2400 into 600. First of all, so this is 2400 into 600 comes to around 14.4 lakhs. But at the same time, now your raw materials will be shown at 300, which is a replacement cost because it's a loss making finished good, and hence your raw materials will be shown, let us say, at 3 lakhs. So if I go to see over here, this is 1584 and 440. And second case mein, this is 1440 and 3 lakhs. Okay, so this is what you will get as we stated over here, 1440 and 3, 1584 and 4.4. Okay, question 8 I would say is similar to a very great extent to question 1. Maybe there is a little more work over here. So opening inventory of finished goods is there, raw materials, purchases, labor, fixed overhead, sales and inventory. The expected production of the year was 15,000 of finished goods. Due to fall in the demand, the sale price of the finished goods was 20 and the replacement cost of raw materials was 9.5. You are required to calculate the closing inventory. Now the thing is, they have not given you finished goods produced or raw materials consumed. So finished goods produced will be the units sold equals opening finished goods plus finished goods produced minus closing. So I know that 10,000 units are sold. Opening units in my finished goods are 1000. Produced I don't know. Closing units in my finished goods are 1200. So if I do this working, the units produced will come to 10,200. Last time they had given you 20,400. Here you will have to calculate. Similarly, raw materials consumed. Your opening raw materials are 1100 plus purchases. 10,000 must be purchased minus closing of 900. By the way, this is 10,200 of raw materials consumed as well. Now if I want to find the cost per unit and total, let us say if I were to start with the raw materials on a per unit basis, 11,000 divided by 1100, that is 10 in the opening, 1 lakh divided by 10,000, again 10 per unit. So basically 10 into 10,200 is my total units. So I must have paid 1,02,000 for the units which are produced. Labor over here is 76,500. Remember that is variable. So 76,500 divided by, I think 10,200 and it comes to 7.5. And fixed overheads, I will say that I am incurring a total of 75 for normal or actual, whichever is higher. So actual is 10,200, normal is 15. So if it's 75 divided by 15 comes to, for example, 5. And I have 10,200 into 5 comes to 51,000. So if I go to see my total cost per unit comes to around 22.5, and this number 102 plus 76.5 plus 51 comes to 229,500. 229,500 divided by 10,200, you get exactly 22.5. So you compare the cost of 22.5 with the NRV of the finished goods, which is 20, and you will select that 20 is the NRV for the finished goods. Now this is a loss making finished good, and hence raw materials will be valued at cost, that is 10 rupees, or the replacement cost, that is 9.5. So basically if I go to see the working, in this working my RM stock will be at 10 or 9.5, whichever is lower, that is 9.5. Finished good stock will be at 22.5 or 20, whichever is lower, that is 20, and accordingly we will solve. This is exactly on lines of question number 1. Okay, next we have question number 9. This is similar to question number 3. I would say this is similar to question 3. Wooden Plywood Limited has a normal wastage of 5%. During the year 17-18, company used 16,000 tons of raw materials at 190 per kg. At the end of the year, 950 metric tons was in stock. अच्छा, वैसे 16,000 into 5% would have given you 800 tons of loss. Actually, आपको 950 tons का loss हुआ, that is 150 abnormal. The accountant wants to know how the wastage is to be treated in the books. You are required to calculate abnormal loss. Now, for abnormal loss, I know it is 150 tons, but what is the cost? Well, 16,000 into 190 is the total cost for my normal units of 15,200, and hence I will take 16,000 into 190 divided by 15,200 comes to 200 rupees. Now this is a 200 per ton cost, and hence your abnormal loss will be 200 into, for example, 150, and hence that comes to 30,000. So this will be your abnormal loss working. Okay, question number 10 is an exam question, and over here the institute has tested your understanding of raw materials, finished goods as well as WIP calculation. So Mr. Jatin gives the following information regarding to inventory as on 31st March 19. They produced product B, that is their finished goods, using raw material X. So there are 3 points. 900 units of raw material X whose purchase price is 100. Replacement cost of raw material X is 80. Now I can't directly take 100 or 80, whichever is lower. I need to figure out for finished goods. 400 units of partly finished goods in process for P. Cost incurred till date is 245. These units can be finished in the next year by incurring an additional cost of 50. So this is my additional expenses. 800 units of finished products and total cost incurred is 295. So if I go to see over here, you will have, let us say, raw materials, WIP, finished goods. Now I can say that cost for each of them, I know this is 295, this was I think 100, and WIP was I think 245. Now I need to find the NRV or replacement cost as the case may be. So expected selling price of the product is 280, subject to a payment of 5% brokerage on the selling price. So this is 280 minus 5% will possibly come to 266. So this is a loss making finished good first of all, and hence as per AS2 this finished good is going to be valued at 266. Okay, then you look at WIP. For WIP I will say 266 minus there is another 50 of cost to be incurred, so this is 216, and hence this will be measured at 216. Now because this finished good is loss making, I will take the raw material cost as lower of cost or replacement cost, and hence this is 80. Now you will multiply this by all the units that are there. Maybe there are 800, 400 and 900. So there is 800 for finished goods, 400 over here and 900 over here, and that will give you your closing stock in your rupees. So this is a fairly interesting question, I would say. As you can see, 80, 216 and 266, and this will be the working to get to your final answer. So this is question number 10. Next you go to question number 11. The company X has to pay for delay in cotton clearing charges. So if there is delay, for the delay you have to pay. Now that is usually payment because you're not paying in time, and hence this is in the nature of interest or finance cost, and interest cost can be added to the cost only if it is a qualifying asset. Okay. Company up to 31st March 14 has included such charges in the valuation of closing stock. Now in my opinion that is wrong because cotton is not a qualifying asset, and hence interest cost should be taken to the P&L. This being in the nature of interest, X decided to exclude such charges from the closing stock from the year 14-15. Is that correct? Answer is yes. This would result in a decrease in profit by 5 lakhs. That's fine. You can give a disclosure for the same. The change done by the company is correct. You are following a wrong policy of adding the interest cost to the cost of the cotton. You have rectified that, which is absolutely right, and you should give the necessary disclosure. So over here, therefore, changes in accounting policy for excluding cotton clearing charges is correct, and adequate disclosure needs to be given for the impact of the profit. Okay, so this is question number 11. Question number 12. Inventory of Rich as on 31st March 2020 comprises of product A 200 units, B at 800 units. The details of cost are material cost, wages and overheads for each unit for product A are 40, 30, 20. That means a total of I think 90 rupees. And each unit is sold at 110. Selling expenses amounted to 10% of the selling price. So this is cost of 90 or NRV of 99, that is 110 minus 10%, whichever is lower. So this will be shown at 90. And product B, material and wages cost are 45 and 35. So this will be 80 rupees total cost. And normal selling rate is 150. However, due to defect in the manufacturing process, 800 units of B were expected to be sold at 70 only. So maybe my normal selling price may be 150. However, in this case, the selling price is, for example, 70, and hence you will compare 80 or 70, whichever is lower, that is 70. You are requested to value the closing inventory after considering the above. So your closing inventory will be over here. I think if I look at the number of units, maybe this is 70 into 800 and 90 into 200. 90 into 200 will come to 18,000. Perfect. And 70 into 800 comes to I think 56,000. Perfect. And hence the total comes to 74. Quite easy and scoring as well. Question number 12. Next you go to question number 13. It's a theory question. In determining the cost of inventories, it is appropriate to exclude certain costs and recognize them as expenses in the period in which they are incurred. Provide examples of such costs as per AS2. This is similar to note 1 which we had studied for cost 3 items. First is admin, selling and general overheads. Second is storage cost unless it is necessary for changes, and third is abnormal loss. That is what they have mentioned over here. Selling and distribution, administrative overheads, abnormal loss and storage cost. So these are the 4 items. You can have any other items as well. Question number 14 is a very basic question, I think, on FIFO or weighted average as the case may be. On the basis of information given below, find the value of inventory by periodic inventory method. Usually, unless given otherwise, you follow periodic inventory method only. That is, at the end of the year, you try to find the inventory value. Okay. As per AS2, for preparing the balance sheet on weighted average method basis. Okay, so this is weighted average clearly given. So you have been given details of purchases 20 into 108, 15 into 107, 30 into 109 and 15 into 107. So this will be your total value. So this is 2160, 15 into 107, 1605, 30 into 109, 3270 and 15 into 107, 1605. If I were to total all of this, this is 8640. Now 8640 is the total cost for how many units? This is 35, 65 and I think 80 units. Divided by 80 if I do, this is 108. Therefore, the weighted average cost will be 108. That is 8640 divided by 80. Details of issue of inventory. You have inventory 1020, 1020, that is I think a total of 60 units are issued, which means closing stock will be 20 units, that is 80 minus 60, and if I follow weighted average cost, this is into 108. So this is 20 into 108. Your closing stock should be 2160 at cost. However, the NRV of the inventory is 107.5. So if I were to find the NRV, this is 20 into 107.75, whichever is lower. So NRV is lower. So this is 20 into 107.75. comes to 2155. Your inventory will be measured at 2155 as per AS2. Cost is 2160, measured at 2155 as we can see over here. Cost or NRV, whichever is lower. Next you have question number 15. This is on a very specific case. Rohan is a wholesaler in agricultural products and has valued the inventory on NRV. On the grounds that AS2 does not apply to inventory of agricultural products. Remember, it does not apply to agricultural products if you are a producer, that is a farmer. Now, are you a farmer? No, you are a wholesaler and hence AS2 will apply. You will have to measure at cost or NRV. Whichever is lower, AS2 will be applicable. This is question number 15, can come for an MCQ. Question 16. The closing stock of finished goods at cost of a company amounted to 4,50,000. The following were included at cost in the total. 100 coats which had 2,200 each and normally sold for 4,000. Owing to a defect in the manufacture, NRV was determined as 50% of the normal selling price, that is 50% of 4,000. This will be sold at 2,000. So you will measure these coats as 2,200 or 2,000, whichever is lower, and hence this is at 2,000. But you have been told that the inventory at cost is already 4,50,000, which would include the cost of these coats. From this we will subtract the write-off, which is 200 per coat into 100 such coats which are there, and hence probably 20,000 will be subtracted. Now second is a little tricky. Shirts which had a cost of 50 and their net realizable value, barabar se dhyan de, was rupees 55,000. So ideally this is already given to you as net realizable value. So you will compare 50 and 55, select whichever is lower, that is 50. 50 must be a part of your initial cost and hence you don't need to make any adjustment again. Commission at the rate of 10% is payable to agents. So generally your temptation would be to say 55,000 minus 10% and hence your temptation would be to say 49,500. Now the problem over here is, if you were given that 55,000 is a selling price, yes, from that you will subtract the sales commission. However, if 55,000 is specifically given to you as NRV, then the selling commission, if any, has already been deducted and hence you don't need to deduct anything again. So this is 49,500. No. In this case, you will compare 50 with 55, select whichever is lower, that is 50, and hence there will be no other adjustment done. And as per AS2, your inventory will appear at 4,30,000. Okay, so this is 4,30,000. Question number 17. I would put this for my LDR. I think I've missed it. It's a good question. An enterprise ordered 20,000 kgs of certain materials at 110. The purchase price includes GST of 12. in respect of which full input credit is admissible. So your net purchase price would be 110 minus 12, that is equal to I think 98 into 20,000 kgs, whatever it comes to. Freight amounted to 1,14,000, 1,17,600. I'll assume that the freight is freight inward and hence it will be directly attributable. Normal transit loss is 2%. So if you are ordering 20,000 kgs, you expect to receive only 2% less, so 20,000 minus 2% comes to 19,600. The enterprise actually received 19,500 kgs, that means they have received 100 kg less, that is abnormal loss. I expected 19,600, I received 19,500, that is abnormal loss, and consumed 18,000 kgs of material. You are first required to calculate the cost of material per kg. So over here that is nothing but 98 into 20,000 comes to 19,60,000 plus 1,17,600 comes to 20,77,600 divided by normal output or actual output, whichever is lower. So this is normal output, this is whichever is higher. So this is 19,600 and comes to 106. So this is 106. And allocation of material cost. So we will say material cost में से 19,600 was my normal output, out of which 18,000 is consumed. So as a part of raw material consumed, 18,000 into 6, 106. There is 1,500 of this in my closing stock. Why? Because 18,000 is consumed, 19,500 was received, and hence 1,500 is in closing stock. Whereas 100 was abnormal loss, and hence this is my allocation. This is my RMC, raw materials consumed. This would be 18,000 into 106, cost of inventory 1,500 into 106, and abnormal loss 100 into 106. It's a good question. So this is question number 17. Next you go to question number 18. Now Alpha sells flavored milk. It's a theory question but an interesting one, I would say. Alpha sells flavored milk to customers. Some of the customers consume the milk in the shop run by Alpha. While leaving the shop, the consumers leave the empty bottles in the shop and the company takes possession of these empty bottles. So the company very well controls these bottles because they have taken the possession of the customers leave. The company, this is an important sentence, the company has laid down a detailed internal record procedure for accounting for these empty bottles which are sold by the company by calling for tenders. So is the company serious in managing those empty bottles? Yes. It is maintaining detailed records, it is calling for tenders, and hence this shows the seriousness of the management with regards to these empty bottles. Keeping this in view, decide whether the inventory of empty bottles is an asset for the company. Now, how do you define an asset? As per the framework, asset is defined as per the framework. Asset is defined as a resource controlled by the entity. Bottles are controlled by the entity due to past events which are capable of giving future economic benefits. Now I can sell these bottles and get some benefits, and hence the bottles are very much an asset. Sir, is it necessary they have to be an asset? Not necessary. It could be possible that these bottles don't give you any benefits. In fact, you have to incur disposal cost, in which case you have to pay someone to dispose these glass bottles, in which case it will be, let us say, not an asset. Second, if so, whether the inventory of empty bottles existing on the date of balance sheet should be treated as inventories of the company and valued as per AS2, or treated as scrap and shown at realizable value with corresponding credit to other income. Now, scrap or let us say byproduct depends on whether you are serious regarding this inventory item. In this case, the facts of the case showcase that you have maintained detailed records, you are calling for tenders, it shows the seriousness of the management in selling these empty bottles, and hence this will be treated as inventory and accounted as per AS2. However, if you were told that the management over here does not have any record procedure, however at the end of the business day it calls a scrap dealer and gives the bottles for a lump sum amount, there's no tendering or anything, in which case you are not very serious about it, in which case it can be like a byproduct and hence can be measured at NRV. Okay, next you have question number 19. This is on standard cost. Kirti is in the business of this is September 24, I think. Kirti is in the business of manufacturing computers. During the year ended 31st March 24, the company manufactured 550 computers. Great. It has a policy of valuing finished goods at a standard cost of 1.8, which can work if your total actual cost is approximately equal to the standard cost. The details of the cost are as under. So raw materials, direct labor, variable production overheads, fixed production overheads, including interest of 100. Remember, computers do not appear to be qualifying asset, and hence 100 will not be a part of cost. In fact, 190 will be a part of cost. So if I take my total cost, 440, 250 should be there. Variable is still production linked, it should be there, and hence 190 will also be there. We'll assume normal equals actual, and hence if I total all of this, 650, 150, 190 comes to 990 is the total cost for 550 computers, and hence your actual cost is 1.8, which is almost equal or rather exactly equal to the standard cost, so there's no problem. Value of cost per computer for the purpose of closing stock, we will say this will be 990, 1.8 lakhs per computer. And this is question number 20. This is from your May 24 exams. I would state this question to be quite important. Wellware Limited is a textile manufacturing company and is engaged in the production of polyester and nylon. So these are two final products. While manufacturing the main products, a byproduct fiber is also produced. So polyester and nylon are main products and fiber is a byproduct. The details of cost of production are as under. So you have the purchase of raw materials. So this is for 30,000 units, wages, fixed overheads, variable overheads, all of this. If I total up 350, 160 and 120 and 60, this will come to 6,90,000. Unless otherwise given, we will assume that your normal and actual is the same. So entire fixed overheads will also be taken, assuming their production overheads. So this is 6,90,000. Output that is made is polyester, this is main product, nylon, that is main product, whereas fiber, which is byproduct. So for fiber, I'll have to find the NRV and subtract the NRV of the byproduct. Closing inventory, polyester and nylon is there. The average market price of polyester is 100 and 60 per unit respectively, polyester and nylon, and byproduct fiber is sold at 40. So if I go to see 3,000 units of fiber into 40, 3,200 into 40 will come to 1,28,000. So this is my NRV if there is no other expense from the byproduct. But there's a profit of 8,000 on the sale of the byproduct after incurring separate processing expenses of 10,000 and packing charges of 9,000. Acha, 5,000 was realized on the sale of scrap. So what will I do? I will say out of the 6,90,000, I'll have to subtract the NRV of the byproduct, but byproduct gives me 3,200 into 40. But to get that 1,28,000, I will have to incur separate processing charges of 10,000 as well as packing charges of 9,000. So I will subtract these and hence I will get approximately 1,09,000. Now the question arises, should I subtract the profit as well? Well, if you subtract the profit, what you will get is the cost. Remember, as per AS2, you need to find the net joint cost by subtracting the NRV of the byproducts and not the total sale price of the byproducts, and hence I will subtract 1,09,000 to get my net joint cost. However, separately there is 5,000 from the sale of scrap, so there is also 5,000 to be subtracted, and hence the net joint cost over here will come to probably 5,76,000. Now the thing is, this 5,76,000 has to be allocated between polyester and nylon in the ratio of their sales value at split off point, which is 12,500 into 100 and 10,000 into 60. So maybe this is equal to 12,50,000 and this is equal to 6 lakhs. So basically, if I want to find the net joint cost, I will allocate 5,76,000 in the ratio of maybe 125 to 185 towards polyester and towards nylon 576 into 60 upon 185. So this is 576 into 125 divided by 185 comes to a 3,89,189 allocation. Achha, this is for all the polyester. However, I have manufactured 12,000 polyester units. So if I want to find the cost per unit, I will divide this by 12,500. That will give me 31.13. As you can see, 31.13 is the cost. For nylon, if I allocate 576 into 60 by 185 comes to around 186,811. Divide this by 10,000 and you will get around 18.68. This is the cost. If I want to find the closing stock, I will multiply this by 1,600 and 400 to get the closing stock in rupees. So this is per unit, this is 1,600, this is 400, and you will get the closing stock in rupees. Now that takes care of all questions. However, we have also added a few questions. They have gone behind the homework section, but we'll probably put this along with the classwork section only. So there is question 9, 10, 11. I want to quickly discuss this. 9 is on fixed overheads. It's an example from the institute material, so you will not see a question answer separately. ABC has a plant with a capacity to produce 1 lakh units of product and the expected fixed overheads is 18 lakhs. Now the fixed overheads based on normal capacity is rupees 18, which is perfect. 18 lakhs divided by 1 lakh. Case 1, actual production is 1 lakh only, so normal is equal to actual and hence your absorption rate will be based on 18 only. Okay, second case, actual production is 90, so you will say absorption rate will still be 18 lakhs divided by 1 lakh, that is 18 only. You will say it will still be 18 only, because your normal or actual, whichever is higher, that is 1 lakh or 90,000, whichever is higher. But in case 3, if your actual production is 1.2 lakhs, your normal is 1 lakh, normal or actual, whichever is higher, is 1.2, in which case your revised absorption rate will be 18 divided by 1.2, which comes to probably 15. So over here, if you go to see, this is based on 15. So they have given you this detailed example in the study material. We have kind of put that over here for your review. Basically, you have to take your overheads at normal or actual, whichever is higher. Question 5 is on retail sales price method. A trader purchased certain articles for 85,000. He sold some of them, not all of them, for 1 lakh 5. So this is your sales. And the average percentage of gross margin is 25% on cost. Usually this is on selling price, here it is on cost. The opening stock of inventory at cost was 15,000. So basically your total cost would be 15,000 opening mein plus 85,000. So this is 1 lakh. The selling price of these items would have been 1 lakh plus 25%. So this comes to 1 lakh 25. This is your total selling price. However, actual sales, if you go to see, was 1 lakh 5,000. And hence there is 20,000 worth of inventory which is unsold but at selling price. Now this is 20,000. If I want to find the cost of the closing inventory, I will say 20,000 is at selling price. That is 100 plus 25, that is 125. Then 100 is how much? Which means you will come down to 16,000. This is like the cost of my inventory using retail sales price method. I have found the sales price of all items minus the actual sales, which will give me the sales price of the unsold items. This is the sale price. Remove the gross margin and you will get the cost at 16,000. Question 11. The cost, I think over here would be the cost. Again, it's an example. We will skip this inventory cost or net realizable value of these two items are as follows: 50 and 45, 20 and 24. You will select individually whichever is lower. So this is 45, 20 and 24, whichever is lower, we will select individually. This is 20. Similar examples are there even later. Over here also a similar example is there. You have an inventory A, B and C. Cost is 40, NRV is 28. We will take 28. Cost is 32. It's indifferent. You take 32. 16 and 24. You take 16. So you will take it based on an individual basis and not on a totality basis. And then last over here, it's from exam May 22 exam paper. Over here it is more like your FIFO type of an application which you should know. SM Enterprises is a distributor of petrol. The detailed inventory of petrol in hand is taken when the books are closed at the end of each month. For the month ending June 2021, the following details are available. Sales for the month of June was 30 lakh 40. General overheads are 4 lakhs. General, this will not be a part of your cost of inventory. And inventory at the beginning is 10,000 liters is 92. So 10,000 into 92 will come to probably 9 lakh 20. Purchases on 1st June were 20,000 liters at 90 and 10,000 liters at 95. And the closing inventory is 13,000. You are required to compute the following as per FIFO, as per AS2. Value of inventory on 30th June. Now, if it is FIFO, first in first out, your inventory which was purchased first was sold first, and hence your inventory of 13,000 will be made up of the most recent units. That is on 30th June you had purchased 10,000 units, that will very well be a part of your inventory at 95. And then on 1st June you had purchased 20,000, out of which 3,000 would still be unsold at the rate of 90. So if you look at my inventory, this is going to be 9 lakh 50 and I think 3,000 into, so this should be I think 2 lakh 70. And hence 9 lakh 50 and 2 lakh 70, probably your inventory is 12 lakh 20. This is your closing stock, 12 lakh 20. Second, amount of COGS. COGS is opening stock plus purchases less closing stock. So if I look at my opening stock, that is 9 lakh 20. That is my opening stock plus purchases. Abhi purchases ke 20,000 into 90 comes to I think 18 lakhs. And 10,000 into 95 comes to 9 lakh 50. So if I total up 18 and 9 lakh 50, I think I come to 27 lakh 50 minus closing stock, which is 12 lakh 20. So this is plus 9.2 minus 12 lakh 20 comes to what? 24 lakh 50,000. So this will be 24 lakh 50. That is perfect. And profit or loss for the month. So profit will be sales. Sales was 30.4 lakhs minus COGS, which is 24.5 lakhs, but COGS will not include general overheads, and hence I'll have to separately deduct general overheads, because general overheads are generic, they're not a part of the cost of the inventory, and hence I will get approximately a profit of 1.9 if I'm not wrong. That is right. So these are the questions for AS2. I hope you have got a very clear understanding of AS2 along with questions in this video. So I'll see you soon with another standard. Till then, keep studying, work hard, and see you soon. Bye bye. Take care.